Hello, I'm Ollin Sykes with the CPA and accounting advisory firm of Sykes and Company, PA. We're located in North Carolina, and today I have with me Scott Sykes, who's also a CPA. We work and specialize in assisting pharmacies with cloud-based accounting, tax mitigation, and compliance services all over the country. And we're glad you're joining us today to learn further about the Unaccountable Pharmacy.
We're going to talk about the importance of quality accounting for an independent retail pharmacy, why you need to pay attention to your accounting, and how it can be an asset to you. We're going to differentiate the accounting systems of today versus yesterday, the way of doing it in the past. With technology today, it's completely changed. We're going to review key balance sheet and profit and loss components for a pharmacy. Then we're going to identify some tax strategies and some real-world examples that hopefully you can utilize in your pharmacy. Accounting is fundamental to all business. It's the foundation for all businesses, especially in pharmacy. In the pharmacy industry today, with reimbursements as tight as they are, it's not getting any better. So you have to understand where your pharmacy is at all time. Quality accounting provides that to you. It gives you that foundation to understand what's going on in your pharmacy each and every day, every month, every quarter. It provides health and efficiency, so you're able to identify issues, any concerns maybe that you need to be working on. Waiting until the end of the year or 6 months later for your January numbers is just not feasible today. It provides understanding. So you understand what's going on in your pharmacy. There's no guesswork. You know if your payroll's out of control or your margins are not looking right. So you're able to understand what's going on in your pharmacy. It allows you to be proactive, waiting until the end of the year for this information. You cannot be proactive for tax planning or anything like that. So keeping up with your accounting on a daily and weekly basis allows you to be proactive, to plan and see what's coming up ahead. It allows you to identify trends when you have good, solid, fundamental accounting. Your data has integrity, and you're able to identify any trends and where it is you're going. You're also able to compare yourself to your peers and see where you stand amongst the industry. And then it provides integrity and structure. You have to have integrity in your balance sheet and structure as well. Typical accounting system of yesterday, it's typically thumb drives or transferring files across the street. Accounting systems of yesterday generally have a lot of in-house inefficiencies, such as manual processing of payroll or manual handwriting checks on Sundays or whatever it may be. A lot of accounting systems are just used as a check writer. You write checks out of it and nothing else really is done in those systems. After the fact data processing, that is waiting until after the end of the year to crunch all this information, give it to your CPA and get a tax return. With the accounting systems of tomorrow, you're not doing anything after the fact. You're doing everything in real time. Lack of daily point of sale controls. You have to have good controls in place with your point of sale and making sure that's updated daily into your accounting system. CPA and advisor pretty much just handles anybody in the region. Today there's niche firms like ourselves who specialize in industries, and especially in pharmacy, the industry is so complex and difficult. You really do need a CPA that specializes in this industry. Teaching your CPA about your industry, you don't know what you might be missing or what you're getting for that. A lot of people in the past have looked at accounting as not important. It's very important. It's critical. You have to have it. The bank account as an accounting system, you just check your bank account. If you got money in there or no money in there, just use that to gauge your performance. It just doesn't work like that. You need to understand the whole balance sheet, the whole profit and loss, how that impacts the bottom line in your pharmacy and your bank account. And then a lot of pharmacies are just afraid of change. If you fall into this category, you need a lot of help because the pharmacy world is changing. You got to change with it. The accounting system of the future is cloud-based. Everything's pretty much can be done through the internet. Daily real-time reporting, so you're capturing information real-time, whether that's through your automating payroll, automating the bill-paying process through Bill.com, for example. Everything syncs into your accounting system on a real-time basis. All of those are cloud-based. There's no transferring files with your CPA. Everyone has login 24/7 through the internet. Accounts payable automation in the cloud, I mentioned that with Bill.com. You scan in your bills, you're able to click and pay your bills, drinking your coffee in the morning. You have full transparency, and everything syncs right in the accounting system, keeping it real time. Payroll automation in the cloud. Payroll is extremely complex, so doing that in-house is not efficient. You definitely want to look towards automating that through maybe one of the national providers, ADP or Paychecks, and not worry about any payroll tax or anything. You just approve the hours and the rates, and they handle pretty much everything. It's a very affordable service, and we actually use a national provider here in-house. The accounting system of the future allows you to be proactive. It gives you that edge. It gives you that real-time information where you're looking ahead, you're staying on top of your accounting, and you're using that accounting as an asset, not as a burden. Provides tax planning opportunities. This again feeds off the proactive point previously. Allows you to see how your pharmacy is doing and where it is you want to go to mitigate any taxes and what you can do to maximize maybe any retirement plans. So it allows you to do tax planning beforehand, before the end of the year. Provides advisory services. We're able to provide that pharmacy-specific advisory. We go to the trade shows. We're constantly involved in everything pharmacy. We have 36 people. This is all we do. So we're able to stay in tune with the industry day in and day out, talking to hundreds of pharmacies. So you really can't get that from your CPA across the street. Video conferences in real time. We have clients who say they're closer to us than they were with their CPA across the street because we do the video conferences, we see them face to face, and we go over all the information on the video, and you really build that connection and that relationship there, and it's just like you're talking to them in person. And as I've been saying, accounting is an asset, not a burden. You can use accounting in your pharmacy to grow, better care of your patients with utilizing technologies in the back office, and grow your pharmacy and improve your quality of life. We're about to go over the balance sheet. The balance sheet is just a snapshot in time. It's extremely important part of the financial system. You need to be looking at your balance sheet first and foremost before you even dive into your profit and loss. Pretty much all the balances on the balance sheet affect your P&L, so having integrity in those numbers is paramount. And generally for pharmacies, you should be accrual basis. Assets on the balance sheet, you want to make sure that your checking accounts, any AR third party, accrued interest, inventory, you want to make sure all those are tied in each month, especially your inventory. That directly impacts your P&L, your margins there. So having a strong inventory system there is paramount. We like to see perpetual systems with periodic cycle counts and some actual physical counts as well to tie in those numbers. So having a strong inventory management system in place and making sure you're reporting that number correctly each month is extremely important. Keeping up with your third-party insurance is very important as well. Making sure you're using a third-party reconciliation service, that you are managing that service and staying in tune to that service, and making sure that the money you're owed is getting to your bank account. So it's important. You can't just not worry about it and just whatever money you get, you get. You should be staying in tune with what money's owed to you and why. And I'm going to see if Ollin has anything to add to that.
The key thing I think you stressed is that the accounts receivable, third-party information needs to be reconciled and reported monthly. The perpetual inventory systems is what we prefer with cycle counts. If you're not using a perpetual system, then you need to do some actual accounts a couple of times a year to have integrity on those numbers, because your inventory directly affects your cost of goods sold and your gross profit. Having this information in real time and reconciled is extraordinarily important, and it ties directly into your P&L.
It certainly does. So I know a lot of people don't understand really how inventory impacts your cost of goods, but it's really three components: accounts payable, your cost of goods, and your inventory. So whatever you've bought, accounts payable; whatever you've sold, cost of goods; and whatever's remaining, inventory. So that's kind of how it links. Making sure your fixed assets, such as your equipment and all those needs, and your depreciations booked or adjusted monthly, also impacts your P&L. And then you've got your other assets, just making sure those are reconciled, tied in, and any adjustments are made there on a monthly basis. Your liabilities, that includes your accounts payable, making sure your wholesale's in there, your wholesale bill, any other payables you have at the end of the year. Any credit cards, we like to keep up with the credit cards daily as we reconcile the bank accounts daily. So you're catching any fraud there, and you're just keeping up with everything daily. At the end of the month, you're not spinning your wheels trying to figure out $100 or $200 here or there. You're keeping up with the stuff daily and staying on top of it. Your other current liabilities, you want to make sure like any intercompany transactions are properly being recorded. Any sales taxes booked as payable, you want to make sure your current portion of your long-term debt is shown. Having your current liabilities accurate as well as your current assets is very important for your ratios as you analyze your balance sheet, which we'll discuss a little later on. But you want to make sure that you correctly identify and correctly have these balances where they should be. You got your long-term liabilities, making sure your bank notes and anything else long-term is tied in and reconciled each month is very important as well. Equity portion, you got your retained earnings. You want to make sure that your retained earnings on your accounting system is reconciled to your tax return. If you don't there, you may have some issues. Actually, you probably will have some issues you need to address. The P&L statement. This summarizes your revenues and expenses. I know everyone pretty much just jumps right to the P&L statement, but believe me, you want to start at that balance sheet and ask questions there first before moving on to your P&L statement. It's generally shown on a monthly or quarterly basis. We like to do monthly, especially in the pharmacy industry. The reimbursement is so tight and so much little room for error. You need to understand what's going on every day, every month. And it shows your income or loss for the period. So we're going to start with the revenues. We have your sales. This should be tied in every day as you're keeping the daily receipts tied in and reconciling your bank account every day. That's pretty a standard figure there. Your cost of goods. This ties right in with the payables and that inventory adjustment. So making sure your inventory is where it should be allows your cost of goods to be as accurate as possible, and therefore your margin. In this example, we're showing 18% margin. This is before rebates, so we like to show rebates separately.
Yeah, I think it's just extraordinarily important that you understand that the receivables and inventory are a direct impact of your gross profit aspect. And as Scotty mentioned, the rebates typically we like to show as other income, but obviously when you're looking at you combine gross profits, you got to net those two together to get an accurate depiction.
So we're going to jump to expenses and rebates. I wanted to highlight the wages expense outside of your purchases and how you buy. Your wages is also your top expense, so paying attention there and making sure that your wages are in line and where they should be is extremely important. I believe the NCPA Digest has your gross wages around 11% or so. We like to see that in single digits of percent of income. In this example, we're about 11%. Our most profitable stores are in the single digits. You need to be paying attention to your wages, and staying on top of your accounting allows you to do that. We also have the other income section, and in our case, we like to show that rebate income separately. It just gives us another data point to analyze and review and discuss with the client and see how they compare to their peers there. We have the other expenses as well, but that's pretty standard. So then we have our net income.
Typically, we see net income from retail pharmacies in the 3 to 7% range pre-tax. As Scotty mentioned, the better performing pharmacies are keeping gross W-2 payroll for owners and for workers in the pharmacy at single digit. And the latest NCPA Cardinal report shows gross profit net of rebates about 22.5%, 22.7%. Definitely the trends are pressuring down on the reimbursement side, but that's what we're currently seeing. For the ratio and key performance indicators, we typically look at the liquidity ratios, the current and quick ratios as being probably the most critical. NCPA norms there for the current ratio, which is your cash, receivables, and inventory divided by your current liabilities, which is money due in the short term within the next year. That number is about 4 to 1 ratio. Most of our pharmacy clients are in the 2.5 to 3 to 1 ratio. You don't want that number ever to go under 2 to 1, but that's kind of a key number we always focus in on each and every month as we look at this, and monthly is the key here. You cannot look at these numbers quarterly or yearly, you'll get behind. Equity to assets, typically we're looking at anywhere from 40 to 60% of equity to total assets as being a reasonable number for a well-established, seasoned pharmacy. Obviously not a startup or a transitioning pharmacy, but a pharmacy that's been in business for a considerable period of time. As we've already mentioned, we'd like for payroll to be single digit. We'd like for other expenses, Xing out payroll, to be in the 6 to 8% range. That's a number that's not tracked too often, but that's the key number. Obviously, the tax strategies, fundamental accounting aspects go hand in hand. And without having the fundamentally good numbers in hand, you cannot really plan for where it is you want to be. So the opportunities with good, solid numbers that have integrity provides that complete foundation, allows you to proactively plan, and provides accounting as an asset/investment into your future, and it's very, very important. The typical strategies we look at, first and foremost, is deferral of tax through retirement plan opportunities and options. There are a series of plans to be looked at, typically simple and SEP plans, SEP plans we see quite frequently. Frankly, we don't like those generally speaking. We generally speaking like to see for a seasoned pharmacy to have a 401k safe harbor, maybe a profit sharing plan, and perhaps a cash balance plan, which is a very high-end retirement program that allows for extreme amount of monies to be put in for those pharmacies in their retirement accounts that are well-funded, maybe don't have a lot of debt, and can provide tremendous income tax planning opportunities. The cash balance plans require an actuary to be in place, but as you can see from this example, you can save a tremendous amount of tax in place here. These can be started late in the year. As far as the cash balance components, they can typically be added to a safe harbor plan, 401k safe harbor that you already have, but you need to have people involved with this that know what they're doing and putting together these plans, otherwise you can get into some serious problems very quickly. Other tax strategies we look at include obviously depreciation write-offs, but before we go to there, I want to talk about conservation easements in a minute. We've got a lot of discussion in the industry and on the street with Congress passing or further making conservation easements much more opportunistic. Last December, in the tax changes they made, this is an area that's very complex. We don't have time to get into the detail of that on this call, but essentially you can protect up to 50% of your gross income with a particular investment into a conservation easement partnership, one that where you're looking at the property on a pre-built basis, then you're looking at the property on given essentially an easement on that property so the property can't be developed, and that easement essentially goes over to let's say a 501c3 entity like Nature Conservancy or some group like that. The IRS gives the contribution differential between the valuations of the two, and the partners in that particular arrangement are able to pro rata write off the conservation charitable contribution easements up to and including 50% of the adjusted gross income. There's some risk here with respect to appraisals. There's some very detailed reporting requirements. There's due diligence that needs to be looked at by you and your advisors if you're considering anything of this nature. But in the pharmacy industry, these are very prevalent at current. A lot of people are very seriously specializing in this particular area. I know here we use some specialists in this particular area to help our clients.
The domestic production activities deduction. So if you are a compounder, generally this would apply to you. Compounders are considered manufacturers to the IRS, not for FDA purposes, just strictly IRS purposes. As a compounder, you're a manufacturer. You must have employees involved. The deduction is equal to 9% of your compounding income or your total income. So the lesser of those is going to be 9% of that number. The key thing here is making sure that you're keeping up with your compounding revenues, cost of goods, any expenses, your wages involved with compounding, and making sure you're keeping up with that, hopefully on a real-time basis as we've been talking, so at the end of the year you can quickly produce a report and get this information. There are wage limitations. The deduction cannot be more than 50% of the wages that you have compounding. But the key takeaway here is to make sure if you are a compounder that you are taking advantage of this, and if you haven't in the past, you may be able to amend prior year returns to get this deduction. But the key thing also is making sure the accounting is in place to keep up with the information needed to report it correctly. As I mentioned, quality accounting is critical here, and you want to make sure that your compounding revenue does make sense before actually performing the work to get the deduction. The deduction may not be worth all the work that you're putting in to get it. So generally, if you greater than 5 to 10% of your revenue is from compounding, this probably would apply to you. Section 179 allows write-off of equipment purchases in year one. You must have net income. It must be put into use in the year. You have to be able to have it in use before the end of the year. New and used equipment qualifies. The deduction limit is $500,000 for 2016, and the spending cap is about $2 million, which generally doesn't apply to most pharmacies. Here's a quick example of this. So just if you were thinking about buying a robot and your net income before that purchase was $200,000, you buy a $150,000 robot, you're able to write off the entire $150,000. Your net income after that purchase is $50,000. So your tax savings at 40% is about $60,000 for an after-tax cost of $90,000. And that concludes our webinar.
I would encourage you to, or in the audience, to call us with any questions that you may have, or go to our website, which is sykes-cpa.com. We have hundreds of videos out there that we update about every 10 days. We've been doing these videos for 5 or 6 years on all kinds of industry-specific topics, a lot of tax issues, a lot of accounting issues, but all relating specifically to pharmacy. So please avail yourself to these videos. Don't hesitate to call us directly if you have questions. These are numbers directly to our desk. We'd be happy to just identify that you've watched one of our webinars. Be happy to talk to you for a brief period of time about how we can help you or questions that you might have. And it's our pleasure that you have joined us here today, and we thank you very much and hope you'll be listening to further webinars that we'll be publishing at a later time.